Good morning. Today is Sunday, September 8th, 2013. I'm Sinclair No, and this is Pat Gorman's Hard Money Watch, brought to you by Resource Consultants. Resource Consultants really should be your precious metals broker. Visit buysilvernow.com. Money Radio, thank you for joining us. It is a pleasure to welcome David Morgan. When it comes to silver, this is the guy. He is the silver guru. David's been following metals since, really his entire life. And he then went on to receive degrees in finance and economics as well as engineering. And he created and runs the silver-investor.com website, silver-investor.com. And he also produces the Morgan Report. That's a monthly research newsletter that covers economic news and the metals markets as well. So when it comes to money, metals, and markets, David Morgan is our expert. David, thank you for joining us.
Thank you, Sinclair. Great to be with you.
Lots been going on in the metals markets since we last talked. There was a point over the summer, I think, where silver may have reached a bottom. I think it was around 18 or so, if I'm remembering correctly. And over the past month or two, we've had a nice run up. What is that other than just a bounce off of the bottom? And let's start with just the outlook for silver.
Okay, well, the outlook for silver is, in my view, still extremely bullish. I've been bullish on silver since the ultimate bottom. And the ultimate bottom was the ultimate bottom, and let me explain. On an inflation-adjusted basis, silver was at the lowest price ever, including the Great Depression, if you adjust for inflation. Again, I want to emphasize that. Back about September 2003. That also happened to be the time Warren Buffett, a billionaire, was buying a great deal of physical silver. Regardless, that was the bottom, and I had the website up and running, and basically it was pretty much ignored, which taught me something I'd already knew, but it verified it, and that's people don't buy bottoms. I mean, this was something that's a valuable commodity that was selling for less than the cost of producing it out of the ground. No one was interested in it, and no one really got on board outside of the really, really smart money, the Warren Buffett, the Bill Gates, and the George Soros. Those three guys were interested in silver at the bottom, and a few others, of course, but basically it was very much overlooked. So that's when I really, was pounding the table. Some people came on board, not too many, but as it started to move up, more and more interest came into the silver market. And my overall look was that silver would go from under 5 to probably over 100 in paper money terms. And I don't want to get hung up too much on the paper price because things can change rapidly in a fiat currency environment. Having said that, it was probably going to be about a 17-year bull market. That's the average length of a commodities bull run. If you read Jimmy Rogers' book, and Jim Rogers is one of the most, best known and most heavily prized analysts out there, also started the quantum fund with George Soros as an aside. Mm-hmm. So if we take that, we're looking at 2003 plus, 15 years or so. We're probably looking at 2015, 16 or so before we see the ultimate top. Between then and now, you're going to have a very rough ride, and the function of a bull market is to shake off as many people as possible. So over the last couple of years, where we saw silver peak out in April of 2011 till present day, going all the way up to $48 rather rapidly from about the $20 level, we've worked all the way back to the low 20s, and a lot of those people in the last couple of years or so are pretty disheartened because most of them have bought silver at a higher price. As far as what you talked about at the beginning, we had a key reversal on the 28th of June, where silver hit in the low 18s, came back up and closed pretty high for the day, exceeding the previous high of the day before. Key reversal is what that is called. And from then, we kind of based for quite a while, better than a month, and then it came up off that base and broke out around the 2050 level. There's a seasonality to almost all the commodities, and they don't always work, but they are pretty high probability. And the seasonality on silver from April 15th to March 15th is an 85% probability time frame. So that's a pretty safe bet. So for my members only, I did a video update and showed them that trade, which you've done in the past, and it's been profitable. But the problem is, of course, that nothing goes exactly straight up or straight down. Mm-hmm. And so right now, we're kind of holding on to that position, but we also have to put a stop in because the market may come down and test, the 22 level, or may test the 20 level, or who knows. As far as what do I think on an intermediate-term basis, I think the low is in intermediately, and I think we're going to probably see 26 by the end of the year, probably before the end of the year. And I think it's going to take some time for gold to get above the 1550 level and silver to get above the 26 level. Once that's accomplished, I'm looking for pretty good things in 2014. But I don't see a really big, huge surge into the metals in 2014. I think you're going to see the later stages of the bull run. And this is going to be once gold makes a new high above the 2,000 level and silver back to the 48 level. I think that's going to take time to get back there. Once they do and they start making new highs, which is really not the time to buy, you're supposed to buy low and sell high, but once they make new highs, there's no what's called upward resistance. So everyone that bought it at 48 over the last couple decades that held it would be sitting on a break-even or higher price than they purchased. And people that have those positions, be it in the stock market or the commodities market, tend to hold or buy more. So there aren't many sellers at a top for a while. And so that means any new buying exerts extreme pressure to the upside, and that's what you see, and that's what you saw in the past in the 1979-1980 bull run. So that's what I expect. I think, again, you're going to see very high paper prices on gold and silver. I do believe they will become overvalued, and not necessarily in terms of paper, although that would be the case, could be the case. I'm going to actually just try to use it in specie. In other words, I'm going to value what gold buys per ounce of gold relative to what an ounce of gold buys historically, and see if it's 2 or 3 or 4 or 5 times that amount. For an example, one that's tried, true, and worn out, but I'll say it anyway, is an ounce of gold buying is a fine man's suit, shoes, umbrella, hat, handkerchief, belt, the whole bit. So if an ounce of gold at the particular time that I'm saying is it overvalued or not, it buys 5 men's suits, then I would suggest that it's overvalued. And gold does fluctuate. It isn't a constant. Over a long period of time, you could say it's a constant, but it does fluctuate like anything else. So if that's the case, then I would say, maybe it's time to look at another asset class. Gold is selling at 4 or 5 times its historical norm. So that's how I'm going to evaluate whether or not we're seeing, a high or a low or whatever in the metals markets.
The recent move in the metals, how much of that do you think was a fear premium? Because we know that people tend to move over to the metals in times of fear. The recent talk about Syria, for example, how much of that would you attribute to the recent rise?
That's a great question. Of course, it's just opinion. I would say my instinct is not that much this time. I think it's kind of the boy who cried wolf. We've been hearing the wars and rumors of wars for so long, and we've had the Gulf Wars going on and off, so to speak, for a while. The Iraq thing and what's going on in Afghanistan. So now we're adding another one. Did that add some emphasis into the money metals? Yes, I'd probably say maybe 20-30%. Not as much, let's say, as when things first broke out with the Gulf War. That would be, I'd say, probably there you'd have like 40-50% of the move was based on fear of the war situation. Not that it isn't important. I think it certainly is, and I think it will add as time goes on because, unfortunately, my view on this is that it's not going to get better. It's going to get worse in the Middle East. So there will be that. Also, you got to look at it perhaps from a sector point of view. I think the U.S. population is kind of burnt out on that fear trade, if you will, but I don't think that's true obviously in the Middle East, which would be a lot of people running to gold, and also in the Asian markets. I think that India and China just keep buying no matter what, and when something like this comes along, it probably adds somewhat more to their purchases.
Now, about another factor, and that would have to be the Federal Reserve and the upcoming talk of taper. Of course, this past Friday we had the jobs report, weaker than expected. Not a lot of ammunition for the Fed to to taper back on their purchases, but it's widely expected that they're still going to go ahead and start to reduce purchases, possibly in September, and if not then almost undoubtedly in October or sometime before the end of the year or sometime around then. What effect is that having on metals? We know it's had an enormous effect, particularly on a lot of currencies around the world, and you just mentioned some of the Asian markets, big effect on some of the Asian currencies, for example. Let's dig into the Federal Reserve and their money printing effect on metals.
Okay. I think we have a pretty good historical background to really make a good analysis of that. If you look back in the last bull market, we saw inflation numbers that were very high under the Carter administration. And you also saw a lot of pressure on interest rates. And the normal thinking is that when interest rates increase, that puts pressure on gold to go down. And that's true to a certain extent. But it's if and only if real interest rates are above the inflation rate. So if you look back in 1980, when Volcker got in, the CPI at the time, which was much more accurate than today, was about 13%. And Volcker put the T-bill rate up above 17. So now you have a real rate, the rate of 17 minus the inflation rate, so 17 minus 13, you have a 4% real rate of return. And it wasn't until that took place that the metals cooled off. Up until that time, an increase in interest rates only added to buying pressure in the precious metals. So I think that same situation exists today and will continue. So on a short-term basis, if the Fed tapers and starts less printing, if you will, I think immediately the metals would sell off, a kind of a knee-jerk reaction, and that would probably take place for a few days. And then I think they'd settle down for just a few weeks, and then I think reality would set in from what I just said, and it's like, wait a minute, fundamentally nothing's changed, and even though we're seeing maybe an increase in bond yields, that they're not sufficient to overcome the real rate of inflation, and therefore the gold trade is still a good trade. So that's how I see it. I see it as a very temporary thing, maybe done deliberately, maybe not, but done regardless, and probably have a very short-term effect, a knee-jerk reaction without any real thinking behind why you're selling the metals. This was announced, therefore I've got to get out of my gold position.
Even though we have had a bounce off of the summer lows, have we started to see some of that taper already baked into pricing?
I think we have. All markets go up and down. It wouldn't be unusual for me to see the bonds. The interest rates have gone up substantially and very quickly here in the last couple months. And because of that, I think it's been overdone short term. So I'm looking for kind of a little bit of strength in the U.S. dollar, the bond market to give back some of that, and for gold to react the opposite way, so for gold prices to come off a bit. So I think you're going to see bonds strengthen for a little while, gold soften for a little while, but you're not going to get back down to where we were in either one of those markets. You're going to see gold, soften a bit, probably for a few weeks perhaps, especially if you see an announcement on this tapering that actually does something, which I doubt, but could. As far as what I mean by that, let me be specific. Does it have any real effect on the economy? No, it won't. I don't care what they do. At this point, they're so far into the amount of quantitative easiness taking place that it's only a matter of time before we have some kind of a currency crisis. I don't care.
Now we're getting to the fun part. Hang on, though, David. We'll take a quick break, and we'll continue with that line of conversation. We're talking, of course, with David Morgan. David is our silver guru. And if you'd like to find out more, silver-investor.com. Silver and a dash investor.com is the website. There you can find out more about the Morgan Report. You can also see a lot of great videos that David's done on on the silver markets. Go to YouTube, and it's Silver Guru, right?
Yes, the YouTube channel is Silver Guru. That's correct.
Silver Guru. More with David Morgan in a moment. Money Radio, thank you for joining us. This is Pat Gorman's Hard Money Watch. I'm Sinclair No, and our guest today is David Morgan. David Morgan is the expert when it comes to the silver markets. He's the Silver Guru, and if you've seen some of his videos on YouTube under the channel Silver Guru, you'll know that David really knows his stuff. When it comes to the silver markets, he is as good as anybody you're going to find anywhere. In addition to the video reports that he does, the detailed reports are found at silver-investor.com. That's the website, silver-investor.com. And there you can find out more about the Morgan Report, which really digs into the silver markets in great detail. David, we were talking about the Federal Reserve's role, their monetary policy, and the effect that that's had on the metals markets. One of the things the Fed has done through all this is they've been just increasing their balance sheet, whereas foreign central banks may at some point or another start to unload some of their U.S. debt securities. Federal Reserve, it looks like they're just going to be holding on to it until it just matures, I suppose. Is there any reason why they can't do that? And then that gets around as well to something that you mentioned earlier, the velocity of money. Doesn't this whole thing really just serve to slow the velocity of money?
Yes, yes to both questions. Could they just hold on to maturity? And the answer is yes, they could. In fact, it's probably the most likely case, and the reason being is that if you look back early on, meaning early in today's world, meaning maybe before, let's say, after the 2008 financial crisis, so we'll take over the last 5 years is what I'm referring to. And if you looked at the balance sheet at the Fed at that time, and then you see what they first started doing with the first easing, you'll see that the quality of assets they're purchasing were pretty top-tier assets. And then there were others kind of in the deflationary camp that said, the Fed is only going to buy, super high-quality assets. They're never going to load their balance sheet with toxic waste. Well, they were wrong, those people. And the Fed has bought a lot of this debt securities that are, these crummy mortgages and paper that really is not very valuable, and taken it off the banks and put it on their own balance sheet. And it's not really worth what they indicate that it is worth. So because of that, that asset not being really worth what its face value is, the likelihood that they'll hold on to it is greatly enhanced. In other words, they're not going to sell it in the market, because if they did, they'd have to market to market, and something that's had 100 on its face value might sell for 20 cents on the dollar. So again, to repeat one more time, I think the idea that they're going to hold some of this toxic waste on their balance sheet until it quote-unquote matures is very likely. The second part of the question is, well, isn't this just doing something to hold back the velocity of money? And in a way it is, because what's happened, and I'm not sure how many people understand this, is that, you constantly hear on the Internet, and I'm guilty of it myself, about, printing of money when truly it's borrowing of money. Mm-hmm. But regardless, but the increase through QE1, QE2, QE3, it's an increase of something. And what it is, it's an increase of debt and borrowing. And so who's been the big borrower? Well, the big borrower has been banks that are insolvent. Insolvent means that you're broke. It means that you cannot survive. So it's like you owe $50,000 and you have 50 cents to your name. You're insolvent. And a lot of banks were insolvent a few years back. So what the Fed did was they made these banks solvent by saying, look, we'll let you borrow more at this interest rate, and you can loan that money back to us at this interest rate. So when you're dealing, if you're buying $100 from your brother-in-law and you got a 2% interest rate, that's not going to do you much good. But when you're borrowing billions and billions and you get a spread of a few points, it does you a lot of good. It makes you solvent again.
Yeah.
So at the same time they were liquefying the banks, everyone says, well, look, all this money, all this printing, quote-unquote, that's going to be inflationary. Well, it's only inflationary if, one, it gets out into the general market and the velocity increases. But that hasn't happened because at the same time that they were increasing the liquidity of the banks, they were decreasing the liquidity of the average American or the average business out there because they pulled a U-turn on the policies that were in place before the 2008 financial crisis and did basically an upside-down maneuver. So let me explain. Before the crisis, we had what was called liar's loans. If you had a heartbeat and could put an X on a piece of paper, you could get a loan for a house. And this was going on, and there was super speculation, a giant housing bubble, which most people that are in the financial markets, even in a cursory manner, understand. But after the financial crisis, you had to basically prove you didn't need a dime to borrow to be able to get a loan, and even in some of those cases you couldn't get a loan. So they did a huge flip-flop between this super easy money policy of giving out money to anybody that could breathe to a super tight monetary policy where you basically had to come in with the ability that you didn't really need the money to be able to borrow at all. Now, on the corporate side, that held true as well, because a lot of corporations are still making a good profit, and a lot of corporations are out there with a huge balance sheet. They got a lot of cash, but they don't want to deploy it because they don't know what's going to happen in the future. There's a lot of uncertainty in the market as far as interest rates are concerned, as far as what the dollar is going to do, and as far as what the depending on the jurisdiction, what the tax rate will be and that type of thing. So there's a lot of money, quote unquote, sitting in banks, but it's not moving. So it's as if someone gave you an inheritance and said, you're going to get, X million dollars, when you're 25, but right now you're 15. So you've got to wait 10 years before you can spend a dime of that money. So that X million is sitting in this account, but you can't touch it. That's maybe a pretty decent analogy for what's going on. So all the banks are liquid. They're in good shape, but it's not going into the public. Again, I want to repeat, because I might have confused somebody, hopefully not, that you don't necessarily need to start loaning that money out, although I'm sure the Fed would like to see that happen. I really think they want to see the velocity of money pick up. But you don't have to for the velocity to pick up. Again, going back to the bond trader example I gave a few minutes ago, that could take place, and that would start the acceleration in a very rapid way. It doesn't necessarily have to be mom and pop on the street for the velocity to pick up, but it could pick up on an institutional level, it could pick up on a mom and pop level, or it could pick up at both near the same time. So there's a lot out there, a lot of uncertainty, and the one thing the Fed really can't control is, again, the psychology of the market. Once the market did go the other way and people decided, you know what, I'd rather own a jar of peanut butter than a dollar bill, because even though they tell me the inflation rate is this, I know if I buy 2 jars of peanut butter and hold it for 6 months, I'm making a lot more. I'm saving more money than I am if I'm keeping my money in the bank. Mm-hmm. And this is something, again, that you can't ever pinpoint, but this is something that certainly I'm sure there are people out there thinking about, especially on the food side. I mean, the food inflation is there. I mean, it's in a lot of areas, healthcare, gasoline, whatever. Housing prices, yes, they're off. So you've got a very tough road ahead, because the more they distort the debt situation, the more they distort prices all over the economy.
And I think one area where we are starting to see that as well is in emerging markets, where there is more of an inflationary effect, more damage to some of those currencies. Specifically, one area that we've really seen a lot of currency damage recently was India. The Indian rupee just hit a historic lows, I believe. At some point or another, I've got to think that some of those emerging market countries' central banks will start selling some of their U.S. Treasury holdings, U.S. debt holdings, and that may have some effect as well. But also, is this driving some of the investors in emerging markets back into the metals markets? India has always been a huge buyer of gold, and I think that there were some distortions that popped up in that market. Are you starting to see a resurgence in the gold markets over in India and China? What's the situation there?
Well, they've been buyers all along, as you know, and if you go back a couple of decades, India was huge buyers of silver. They really, on a general population basis, couldn't afford gold. That's not true as of the last decade or so. So they've always bought gold. It's just that now that their economy is better overall, they more can afford it. So a lot of them have, started buying, more gold than silver, perhaps. But the idea that the rupee, they're very aware of, fiat money and what it means. I mean, there isn't hardly anyone in India that isn't aware of the fact that the stuff issued by the government is going to become worth less and eventually worthless. And so they have always saved in real things, and silver and gold primarily. So that hasn't changed. It's certainly accelerated. I mean, the Indian government, as of late, as you know, Sinclair has put on different edicts to try to quell the appetite for gold, and it's really backfired. There's more smuggling going on than before and that type of thing, but trying to curb the Indians' appetite for gold. Again, it doesn't work. These, controlled markets never do. China as well. China has not done those things. India has. But China basically is seeing, got governmental-wise a pretty good appetite for gold. They keep adding to their position. And citizen-wise as well. So the East has continued to be gold purchasers, and the West continues to be drained of their gold. And I think that trend is going to continue for some time.
Any seasonality or other special ideas that we should keep in mind for the gold and silver markets for the remainder of this year?
Well, seasonality-wise, I already said, from August 15th to March 15th, silver and gold both basically go up. And that's, again, a pretty high probability. I do want to caution something I was incorrect on last year, and that was how the market's going to go to the end of the year. It happened the last 2 years, and that is the markets get very thin, meaning there's very few traders in these markets the further we approach the holiday season. And because of that, these markets can be moved one direction or the other fairly easily with a very small amount of money, relatively speaking. And we had some great sell-offs going into the last trading day in the precious metals the last 2 years. So I actually think it's probably going to take place again this year. So if you're looking to position trade, or you've got, tax reasons or whatever your reasons happen to be for wanting to know what the futures hold, certainly I don't have a crystal ball. Nonetheless, I would factor into my thinking that if silver does make a big rally and gold, and I think they're going to do pretty well here for another few months going into the end of the year, but the levels I'm looking for, the 26 and the 1550 for this year for gold and silver respectively, I think those will happen before the end of the year. I think you're going to, again, taper off to the end of the year, look for them to kind of fade off as the amount of trading diminishes.
We're talking with David Morgan. David Morgan is the silver guru. You can find some of his videos online at YouTube. The channel is Silver Guru. If you want more detailed reports, though, go to silver-investor.com. silver-investor.com. That's the website, and there you can find out more about the Morgan Report, which is the monthly newsletter that covers the metals markets and the global economy and currencies and everything else in much greater detail. We'll continue the conversation with David Morgan in just a moment. Money Radio, we've been talking with David Morgan today. It's always a pleasure to get together with David Morgan. He publishes the Morgan Report. Silver-investor.com is the website for more information. David, we've got to touch on the gold-silver ratio. and what that is showing us now, and just the general outlook for silver as well with regard to it as an industrial metal. And then I've got a quick follow-up for that one with platinum as well. Let's start with the ratios. Where are we now, and is there any advantage, and are we looking at any ranges here?
Well, we are. I mean, the gold-silver ratio is, how many ounces of silver does it take to buy an ounce of gold, and it varies. We've seen it. It's a good indication for which metal is outperforming the other one. As an example, when the bull market started, the ratio was 80 to 1. So it took 80 ounces of silver to buy an ounce of gold. Right now, we're sitting there in about the high 60s. And so what it says is from the inception of the bull market that since it's, 67 or so, that's lower than 80. So from that context, meaning all these years, probably, a decade's worth, silver's actually outperformed gold. Having said that, outperformed how? I mean, it's been a much wilder ride. Silver is much more volatile than gold. I've never suggested anybody go with silver-only, purchase. I think you should own both the metals, if not perhaps, I said the ratio was 68. It's actually 58. Sorry about that. So the gold-silver ratio, during this last couple of years where we had this consolidation to downward bias, really hasn't gone much between like 65 and the low we're now about 58. So what that really says to me is the ratio has indicated silver's actually held its own fairly well. If you get a real extreme market, you would see it go above 70 or back to 80 or perhaps even 90 temporarily, which it did during the 2008 panic, and it only was there very briefly, like a day or so. But we haven't seen that. So what that indicates is that there's more steadiness in the silver market than you might just think by glancing at the price and how volatile it is.
And what about in our final couple of minutes, what about the industrial applications? Are we going to see continued strong industrial demand for silver over the next few years?
There'll be moderate to strong, yes, because there's no substitute for silver. I mean, the substitutes for silver have all been used pretty much. Will there be other ones that are invented? Probably. But it's going to be big in nanotech, which nanotech doesn't use much silver, but nonetheless, it's actually one of the best nanotech elements out there. The solar industry has gone up substantially. It kind of waned or leveled off, but China and Japan have indicated they're going to continue massive solar projects. We'll have to see if that's to be determined whether that holds or not. If it does, it will add a great deal of pressure on the industrial side of the silver equation.
And what are your final thoughts on platinum as another option?
I think platinum is something that people ought to consider at this point in time. With the South African gold strike going on, most of platinum is mined in South Africa. It's 30 times more rare than gold. It's used in a lot of catalyst and chemical-type processes. It's essential, and also it's quite popular as jewelry in Japan and somewhat in China. So I think platinum is undervalued at the current time. I think it's worth having a look at.
David Morgan. David, I always enjoy our get-togethers. I enjoy our conversations. You bring such interesting news on these markets. And if folks would like to find out more, of course, I'm happy to send folks to silver-investor.com. The Morgan Report, great information. Also look for some videos by David on YouTube. The channel is Silver Guru. I'd also like to thank Pat and Linda Gorman from Resource Consultants. Resource Consultants really should be your precious metals broker when it comes to physical delivery for gold, silver, platinum, coins, and bullion. Pat and Linda Gorman have been doing this for a long time, and they do a great job. To contact them, 480-820-5877, 480-820-5877, and the website for Resource Consultants is buysilvernow.com, buysilvernow.com. Our guest today, David Morgan from the Morgan Report. Thank you so much, David.
My pleasure. Thank you.
Silver123.net is a silver saver program designed to be as simple as possible. For as little as $50 per month, you can set up and create an automatic cost average buying program that will get silver or gold sent to your door on a monthly basis. The first step to creating an account is easy. You will supply some basic information. Next, you will add a bank account from which you will schedule your purchases. Scheduling purchases makes saving easy. Silver Saver is customizable and allows you to control the amount and the date of purchase. Once you are signed up, you are then given your affiliate code. Now you can save in precious metals and also market this program. You can use email, web pages, and multiple forms of social media to share the Silver Saver program. Silver Saver will reward you generously with physical silver or gold whenever someone you refer becomes a saver. Silver Saver not only provides you with a share code, but also allows you to place your own banner ad on a website of your own. Silver Saver is one of the best ways to start saving and accumulating gold or silver, especially at these levels. Visit silver123.net and start saving today.